All right, everybody. Let's get started with my presentation for this week. We'll be talking a lot about some of the data that came out this week, but also lots of macro ideas that I think are very long-term oriented for investors in general. Again, just our views, nothing with the crystal ball mentality here. Um, Today, we just saw the unemployment rate number came out. Most of labor data came out. If you aggregate the last four digits of the payrolls, it is trending lower in a significant way. You can also look at the unemployment rates is at the highest level since 2021. Now, there's some question about the validity of that data, certainly, but nonetheless, there is certainly a weird situation where you also look at the ISM manufacturing, which has nothing to do with this labor data in the BLS and so forth. And it's also showing softening in the labor numbers. So I should say that is a survey, not an actual data, but it is certainly, I guess, important to add that to the picture as we consider all these macro settings. Um, and so clearly looks to me like employment is weakening, but inflation, on the other hand, has been strengthening in a large way as well. And which brings me to this sort of inevitable, situation where the Fed is potentially facing, and I don't care what Fed would be in this position. Eventually, we have to take care of our finances at home, meaning the fiscal situation, and ultimately that drives rates lower and allows inflation to run hotter than historical standards. Now let's speak about the elephant in the room, which is this chart. This chart was something I worked on last week. In fact, just the history of how this chart was created was basically I was talking to Roni Sterfole from Incrementum AG, and he asked me to update one of my charts for his letter. We collaborate on those things, and so I'm happy to share data with him, and I always use his data as well for my own research. And so it's certainly a collaboration. But in the middle of that research, I was the former version of this chart was not this, and I was going deeper into something I had it wrong in my analysis. I wouldn't say necessarily hugely wrong. I mean, if you look at the foreign holdings of U.S. Treasuries, you're going to find that number has been rising at all-time highs, and it's always been fascinating to me that number continues to grow, despite the fact that we're hearing everyone saying that central banks have been buying gold and they're really not acquiring too many US Treasuries. Then you looked at things like Japan's accumulation of Treasuries recently, Europe's accumulation of Treasuries, but the number wasn't adding up. And so I was diving in a little deeper at the FRAD website. Suggest everybody to go look at that website. There's so much information there, and as you dig in deeper, what you find in that whole analysis is that there's really two series. One series that shows the total amount of holdings in U.S. Treasuries by foreigners, and there's another one that is specifically for central banks, and the conclusion is that they're very different. One, the central bank's holdings have been certainly contracting in nominal terms, not just relative to total amount of debt outstanding, because the debt has been growing so much that we know that the buyers out there are not buying as much as they used to. But I wasn't aware. I know people have been saying this, but nobody has really shown the actual data outside of looking. And trust me, I'm the one responsible for also putting this data out. And so the way I've been reporting this is always looking at relative to how much Treasury is outstanding, which is a fair way to assume that there's a lack of appetite to buy this. But in nominal terms, now this is showing a decline, which is key. And when I looked at that, I was like, well, hold on a second. Now I can put this in the same scale because we're talking apples and apples. We're looking at holdings of treasuries relative to foreign reserves, and we're looking at gold holdings relative to foreign reserves. And that's when I found, when you apply gold prices where they are now, you were above the percentage of where we were in terms of holdings. And so let's dive in deeper in this chart. You can see that the yellow line, I mean, if you see this, first time since 1996, what an incredible data point. Now, what is remarkable about this is that if you think about it, we're just getting started most likely, because back in prior eras, like the 1970s, we reached close to 60%. Again, 60% of foreign holdings of gold relative to their foreign reserves. If we include the Fed, is about 74%. So all I'm here to say is that the imbalances that we had back in the 70s versus what we have today are severely worse, which makes me believe that the amount of holdings relative to foreign assets is going to have to grow substantially. Again, in my opinion. And if that's the case, you have to think about how does that percentage increase? There's two ways. One, through accumulation of gold, or through a appreciation of the price, i.e. a revaluation of gold price. And so you start getting to a scenario where you have, and this is what I like about macro. You have this very long tail of a constructive view on gold prices, where that the largest buyer of gold itself is pretty much forced into purchasing more or revaluing the metal. Okay, that's my view at least. And then number two, you have a situation where a bunch of securities that are linked to those metal prices are extremely cheap. I don't think I've ever seen a setup like this from a macro standpoint. I'm talking about miners, obviously. You look at the mining industry today, where are they trading relative to where gold prices are? And majority of these companies are trading as if gold prices were at 2,000, even sub that amount, dollars an ounce. And so I think that's the way to express that view in the markets. I'm always thinking about not just interesting data to point out, but how to approach this as an investor. This chart I just put out this morning, and I think it's very relevant for this discussion as well, because we were talking about how central banks are boxed in. Well, let's talk about the US alone, because what it appears to me that a lot of macro commentators out there have been separating yields in the dollar and talking about these instruments as if they were different. In my view, they're extremely similar, if not the same, in this environment we're in. Of course, in prior eras, you should be separating them. They have been behaving closer and closer. You can suggest that the dollar has been moving a bit ahead of yields, and maybe yields need to fall much further. That's my view. That doesn't make me bullish on the dollar. No, I think that these three instruments, it's almost like it's not just a view. It's not just it's almost like this is becoming a policy, an unavoidable policy, where you need to get suppression of yields in the dollar. And the main reason for this is actually fairly simple, is because we're running a twin deficit. For those who don't know twin deficits, we often talk about the trade issue, the fiscal issue, but lack to discuss the problem with the trade balance, i.e. what Trump is trying to do with tariffs and all these things. Well, it's not that we're seeing a large deficit on the trade front. Structurally, the trade issue is becoming very pronounced. And when you add that to the fiscal side, this is extremely severe, what we're seeing here. And so how do you fix that with also an extreme amount of debt? Well, I think something has got to give. You got to lower the debt burden to service the debt. which is through the yields. And you can't allow at the same time the dollar stay at record valuations relative to other fiat currencies. You have to devalue the dollar substantially. And so let's look into this one. You have now the Big Mac Index. It's an interesting way of looking at the world. For those that travel as much as I do, and I think Kevin and Quentin certainly travel a lot as well. What you find is that very clearly is I cannot recall, and I moved to the U.S. about a decade and a half or 2 decades ago, and what I can tell you, I don't remember seeing the U.S. economy as expensive as it is right now. It's remarkable to see. You go to the mall, you go to restaurants, and we find it normal to spend over $200 for a dinner with in two people, and it's just fascinating how this is not normal. You go to any other country, you don't pay that the same amount, and I think inflation is a phenomenon that it's slow. It's sort of it doesn't work its way into the system so quickly. It actually takes its time, and it sort of changes the behavior of people. Now you're seeing folks starting to cook more at home, and all these trends that are now being really unleashed because of the cost of living. Folks not being able to afford homes and all. I mean, this is a real problem. And what I find fascinating about this chart is that if you're from Brazil, which I am, it was normal back in the days it still is actually, to take somebody. Let's just say you're taking someone on a date, and you go to McDonald's to have a Big Mac. It's not it's not uncommon for teenagers to do those things, or even older people to go to those areas. Why? Because it's an American brand, and you don't have those things often in those countries, and so they appreciate the fact that you can have that in those areas. And so usually those things have been always very expensive, and so maybe that's why I find it so important to see that the U.S. is and I know, I live in the U.S. We know for a fact that everyone sees McDonald's and all these other brands as places where we don't announce to our friends, "Hey, I'm going to get a Big Mac or something." It's a thing that people do it more hiddenly, I guess, relative to other countries. And so I find it fascinating the fact that today a U.S. Big Mac is costing more than in other parts of the world, and I think that speaks volumes to this idea that it's so expensive to live here. Now I'm speaking living in Denver now. That people are starting to think, well, I can have a great life in other countries and for much cheaper. And you have to think from a macro standpoint, adding to that whole idea from a flow perspective. You start to see that more often. Capital has to leave US-based assets to go somewhere else. It's the same thing that happens with equity markets. Now you start seeing folks say, well, equity markets in the US are too expensive. I'm maybe going to venture myself into foreign markets a little bit. I'm willing to take that risk. Maybe I'll start with Japan. Maybe I'll start with Europe rather than emerging markets. Remember that whole idea of acceptance of risk. And I think that that's an important discussion here. And so notice that most developed economies are the expensive ones, and most of the emerging markets and less developed economies, arguably China, but it has less developed because most parts of China are less developed, and there's parts of China that are very developed. But for the discussion here, and I don't think China would change my opinion on this, and it shouldn't change yours. I think it's fascinating that a lot of emerging markets are so cheap. All right, well, let's talk about something else here. U.S. yields have been declining, and I think this is just an illustration of what I said before, where, if you go back in this chart where you're seeing the U.S. yields and commodities, you can also do this with inflation expectation in the market, or the big break-even rates, which recently, they usually trade very closely. So yields tend to trade very close with inflation expectation. And now you're starting to see this divergence. It's because of the potential changes in the Fed and the Trump administration trying to force the policymakers in the monetary front to lower rates. And so all these types of things are causing this divergence in the market where market participants begin to price in, well, we're going to see more inflation, and also we're probably going to see a reduction of rates. That's the world we're in. And if you think about it, what is the release valve of that from an investment standpoint? Well, it's hard assets. And so I'm extremely constructive on hard assets, particularly commodities. I think that you can not just be bullish in gold. You can really diversify that view in all sorts of hard assets. We happen to have an opinion that mining is extremely cheap, and mining is related to hard assets. It's a hard asset generating business, and I think that that's one way to express your view. There are plenty other ways to express your view. Now, right now, energy is really cheap, and nobody's seen the opportunity there either. And agricultural commodities are also very interesting. Like, notice that these commodity trends, they happen in a dynamic way where you tend to see a rotation, right? I mean, now gold, the metals are at the top. Everybody likes the metals, but 6 months, 12 months from now, it could be energy. It could be agricultural. You don't know. I don't know. But certainly when you're in the commodity bull market, you keep going up and down in that whole rotational dynamic of commodities. One thing I noticed is that GDX ETF assets under management has been making new levels or record levels recently. This is also a function of price. Keep that in mind. Prices are trying to break out and make more with authority new highs and break that 2011. Remember that we're well above those levels in the gold price. So when you think about the opportunity here, because the first thing assets under management, record levels, and you're telling me we haven't invested enough in mining. Well, if you look at the gold miners to gold ratio, what you're going to find is that we're still 60% below the peak levels from 2011. In other words, there's a leverage that happens on the way up and on the way down that we have not appreciated given where gold prices are, in my opinion. I think that's the whole point of this. Speaking more specifically on energy, this chart is fascinating to me because we've been talking about drill baby drill policies in the US and been talking about we're going to increase production, and production has been trending higher, indeed. But one thing we haven't noticed that happens actually with the lag in terms of the effects of this is that operating rigs in the US have been starting to decline, and very severe declines. I mean, we're seeing 15% in the last 4 months, which is the highest or the lowest, I should say. Well, depends on how you're going to frame it, but it's the highest contraction that we've seen since the COVID lockdowns, or the lowest rate that we've seen since the COVID lockdowns. And so, I do think this is eventually going to cause an issue in oil. I think oil is very mispriced. I think also energy companies are mispriced. We are seeing lots of volatility in energy recently, particularly in oil. If you notice oil companies relative to oil itself, they've been doing quite well. They've been doing, they quietly well, which I find remarkable. In fact, if you look at the energy stocks ETF, you can see that we've been sort of bumping into this resistance for some time, and potentially could be breaking out. And I think that's going to be the case. I feel very strongly that miners should be looking at how to secure their margins at all cost. I mean, it's easy to be at the top. Well, not easy, but it's when you reach the top, of your career, of your success of as a company. The immediate reaction I have is how do I maintain that position over time? Consistency is always the hardest thing, and so maintaining that position in this case and how it applies to a mining company certainly is thinking about securing your margins. And energy costs is a large percentage of that for most mining companies. And so consider that idea as how to hedge energy costs if you're part of this, because I'm really I'm trying to be someone who speaks about this industry, hopefully shares informative things about this whole industry. And I think it would be important for leaders in the space to be aware that the gold to oil ratio is doesn't stay at these levels for a very long time in history. The silver to oil ratio also doesn't stay at these levels in history. Even the copper to energy cost is also extremely high. Hence, why you're seeing these large margins. And so, think about how to hedge that risk, because it's a real risk for the industry. Silver prices quietly moving. Lots of skepticism looking at this and saying, gold has been moving more than silver. I don't understand why silver is not moving a lot. It does not matter to me at all. The fact that we're in this 40 or above now, but 41, 42, 43 dollars an ounce at silver prices with the gold to silver ratio at these levels, it's just the most bullish thing I've ever seen in my career. Again, these are just my opinions, and I've said this multiple times in the past. I do think silver is the most undervalued metal on earth. And it's not because, and some people would say, well, what about platinum? What about this? Look, I just have a pretty good grasp of supply where we are. I have a pretty good grasp of the demand potential for silver in terms of where it comes from monetary side. It comes from also industrial side. It comes from solar now. And I don't think that's ending anytime soon. And when I see the constraints on the supply front versus where we are with the demand, versus where I think we could go with gold prices, versus what what history has told us in the past about the monetary aspect of silver itself. Yeah, I'm very constructive on how silver could be trading in the next year or so. Like I do think we could see new highs, and that's a possibility in markets that I'm very have a high conviction on. In fact, if you notice, one of the longest running mining companies in the silver space, in fact, the largest North American silver mining company today, is Hecla. And Hecla has been, it's been, if you notice the trend here, I mean, we've been in a downward trend all the way back to the 1980s. Lots of people will look at this and say, why would I ever own these things? And I find it interesting when people mention just because of the past, because something hasn't worked, it's not going to work in the future. I'm not when there's reasons to believe that you can take the contrarian view, you don't want to be contrarian all the time, but when there's, real justifications to take that contrarian point, that's where I think the real money is made. And so I think that's the case here. If you think silver will make new highs and probably go above 50, remember where we're trading in the 80s? We could see that with most securities that are producing that metal. And so if I'm of that view and I looked at this chart and there's a break of a major resistance throughout history, we're talking almost 50 years of a downward trend, and we're breaking that now. And no one has mentioned this. Nobody has mentioned that we just broke a 46-year downward trend and in the largest North American silver mining company. And some people think this is unique to this. I do not think this is unique to the security. I think this is common in all fronts for the whole industry. And so, yeah, it's extremely positive to see this, needless to say. Silver prices going up, as I mentioned before. Silver production going down, as you can see down below. Mexico is what you would call the equivalent of the Saudi Arabia of oil in the silver industry. And I think this is an important chart because if you notice, back in the early 2000s, silver prices began to rise with a lag you saw production rising. Now notice that silver prices have been rising since 2020, and we have not seen the blue line rise at all. Why is that? It's because there's real constraints. I mean, do you know of any major mining uh, um, project in the silver space that's going to be coming online anytime soon that will change the supply curve of the metal? I don't. And we do know that it takes about 10, 15 years. 10 years would be very optimistic. 15 years to get something from exploration to production. And so this makes me believe that, we haven't seen much of that mismatch being reflected in markets yet, a mismatch of supply and demand being reflected in markets yet. Copper miners versus Chilean stocks. Well, I've been talking about this next wave of emerging markets, and I was mentioning this to to someone the other day, that the same way I've really pivoted. At least I view Kraska as well. But my personal career, I've definitely made a pivot back in 2018, 2019 into precious metals. I think the next pivot here, if it will, and that's not to say that I think precious metals and commodities will lose its way. It's actually an add-on to that view, is that emerging markets are going to do extremely well. And it takes time. It takes time. You need to have the metals and gold and others to do very well. This is happening right now. I think Chilean stocks, which the Chilean economy, I mean, you may say, well, the Chilean ETF and index don't have a lot of Chilean copper mining exposure. Why would you compare with copper miners? It doesn't matter. Inherently, the economy is very much driven by copper, and copper prices and the copper cycle overall. In fact, you can see this incredible connection between the two. And recently, we've seen a break of that, and that's been caused by the neglection that happened even further on emerging markets relative to mining. And I do think it's going to come back. And so that's your potential cheaper, more undervalued way of playing the copper trend that is, in my view, clearly unfolding in front of us. But there are some instruments that are linked to those things that have not reflected that yet as well. You can also look at Brazilian equities, and I've seen this chart. I've looked at this chart in many different ways. You can look at it weekly, daily, log, not logged, and all sorts of things. And I think that the best way to look at this chart, of any chart really, is quarterly. Okay, and we're really on the brink of something here. We've had 3 candles to hit up against that wall of a resistance that has been a very significant resistance over time. And there's a moment where people lose faith, and that's usually they throw in the towel and they say, enough's enough, I'm out of this. That smells to me what's happening with the Brazilian equities. Immediately when you post this, people start talking about Lula and all sorts of things. What they don't see is that Lula is 80 years old, 80 plus years old, and also has cancer. This is not to say that I'm thinking the guy will die. It's just a natural path of life. And most importantly is that there's nobody behind him. Who is behind him? Who is underneath the guy that will be the next popular candidate to take on his party? I really challenge somebody to tell me who that is. And on the other side, you have all these new emerging people, Tarcísio, the governor of São Paulo, and others, really trying to make a breakout here for elections. And I, see the structural changes in South America. First, you have Argentina, then you have Bolivia, now you have Chile. Guess what? Brazil is next. Elections are going to be next year for presidential elections. I think the market anticipates that. It doesn't wait for the end of it, for the results. And so notice what happened in Argentina. It's a great playbook for this. And I love Argentina as an investment as well. I think that that's an interesting environment because you saw the inflows coming in way before elections. I think that could be the case here. I mean, notice the prior chart. You've seen this movement in Chile. you're kind of missing a little bit of that in here. So why? Because elections in Chile is in November, and then Brazil is next November or next year. So I think this is a really interesting a setup for a breakout that would change. And some people like to say, "Well, I like to wait for the breakout." That's fine. That's on you. I learned from Paul Tudor Jones. The real money is made on really anticipating those breakouts in a big way. That's where the big candle comes. All right. Emerging market currencies, if you notice, okay, well, we haven't broken out yet. Well, look at emerging market currencies. They seem to be leading that already. So we've broken that line, and now we're probably headed much higher, in my opinion. And so this is why I'm extremely bullish in this space. Gold, another thing just to finish on emerging markets that I think is important. This is a chart from gold that ends in January 2024. Do you notice that pattern that you're sort of, really lots of resistance at that line that I just dashed, that dashed line that I put it in the chart. And guess what happened right after that? Boom. That's the big, run up that you have in gold prices that, that was a triple top that people were saying, this is it, we're going to go lower and so forth. And guess what? We didn't. That was potentially the beginning of a cycle. All right. Well, let me show you another thing now. This is something that a lot of people are skeptical, but it's a very similar sort of stubborn line, that we've been sort of in that range, if you will, for some time now, since all the way to the early 2000s. Where do I think we go from here? I think we break, and we're going to probably see something similar to this. And so I'm very bullish in the space, and that's just to say that I love these long consolidation periods because people lose faith, they're not positioned, and then things change. And all my views on the dollar and yields, and they fit perfectly here. This is why I'm excited. All right, railroads. Look at the percentage of ownership of railroads stocks back in 1800s. It was about 63% of the market. And this reminds me of what? Technology today. And, I don't know how this unravels, to be honest, and I don't think anybody knows. You can claim this could be a burst moment like the tech period in the early 2000s, or you can say that potentially it's going to be a rotation. I want to say that either if it's violent or not, if it's a violent move out of a sector into other parts of the economy, I'm extremely excited about this. You've got spenders, the AI spenders, the infotech guys that have about $30 trillion of market cap and bunch of, just the Max 7 alone are with close to $3 trillion of assets and could leverage, a lot of that and finance a lot of the infrastructure we may see in the future. Do not underestimate that. But think about who the earners are, where that money will go to. And I think the earners are energy, infrastructure, and materials. I've said this before. I like those buckets. I think those buckets are going to do. I think the spenders will fund and the earners will compound. That's my opinion. So, we wrote a letter about this. If you're interested, you can go to the website at crescent.net and read about it. One thing to notice here as well, as we see those rotations happening, right now, it's been a pretty peaceful rotation in the market this year today, right? Markets are up. Nobody's noticing the change, but gold miners are taking the lead. Gold miners are up about 90%, while the entire sector of the S&P 500 is up, but definitely not as up as much as the gold miners, the copper miners, and most of the these metal related businesses. And so take note of this. This is not, and if you look at the gold miners relative to S&P 500, you will notice as well, we are at one of the lowest levels in history, which makes me believe this rotation is just getting started. Now, remember, the mining industry is a blip relative to the size of these other sectors of the economy. And so, we need the mining space if we're going to build AI infrastructure. So keep that in mind. Metals are going to be critical here. One thing I would like to notice, I call this, is that a Mar-a-Lago Accord letting yields rise relative to the U.S. to devalue the U.S. dollar? I think that's the case. If you notice, year to date, since Trump took office and this year, you can see we've been seeing a trend across most yields elsewhere in the world versus the US. And I think that is, do you think that's a coincidence that we're also seeing one of the worst declines of the dollar since the 1970s? No, it's what supports a currency to move higher is letting yields to rise. And so I think the US is doing this on purpose. I think they are causing other yields to rise relative to the US to force the currency to devalue, because, as I said before, this is an unavoidable policy, in my opinion, to devalue the US dollar versus other fiat currencies. And so think about this. I mean, what's the risk of investing in emerging markets usually? Well, it's if yields are rising in developed economies, especially in the US, US is the main thing. Or if you have a problem where the dollar is too strong, usually causes emerging markets to be very lots of turmoil in that part of the world. We're probably not going to see a world like that, in my opinion. That's my view. We're going to see a compression of the two. So dollar and yields. And so, consider this as potentially the Mar-a-Lago Accord, in my opinion. All right, guys, that's it.